Welcome back, guys. My name is Jarrett White with White Ridge Mortgage, and today we're going to talk about all the basics of getting a mortgage in Canada. By the end of this video, you should have a better understanding on how mortgages work than 99% of your peers, and when you go to get a mortgage, you'll be able to put your best foot forward, making sure that you get the best options available. So let's start off with the basics. What actually is a mortgage? Now, I'm sure you know it's a loan on a home, but what actually makes it a mortgage? Well, it's a loan that's secured against a home as collateral, and it typically takes a very long time to pay off. This is exactly why the word mortgage actually comes from the Middle Ages in French, meaning death pledge, because it probably took until you died almost to pay it back. Well, nowadays, not quite, but it still takes a very long time to pay off. Basically, a loan being secured just means that the bank is lending against something and they're using that item as collateral. And in this case, it would be the house. So if you're not paying the mortgage, they can take that house away, try and sell it to recover their investment. Now, when you buy a home, you'll need to decide how much of a mortgage you're actually gonna need. And it's a very simple calculation. All you're gonna do is you're gonna take the purchase price of the home minus your down payment, and that's what you're left with for a mortgage. When it comes to the other costs with purchasing a home, like legal fees, property transfer tax, appraisal fees, that cannot be included in the mortgage and will need to be paid out of your own pocket. The only time these costs can be covered with the mortgage is if it was a refinance and you're essentially taking out an equity loan on top of your normal mortgage to account for those costs. Now, here's where things get a bit confusing. The amount you put down will actually determine the structure of your mortgage. If you put 20% or more down, you'll be getting what's called an uninsured mortgage. Now, if you put less than 20% down, you'll be required to get an insured mortgage and pay for mortgage default insurance. It's very important to understand that this insurance that you're going to be paying for is not actually for you. It is for the lender, and it protects them in the event that you're not making their mortgage payment and they have to take the house away and sell it, and they might not recover all their money. So essentially that insurance is going to top them up to make sure they're at least getting their investment back. This insurance cost is actually quite substantial, and if you're putting the minimum of 5% down, this is going to be 4% of your entire loan amount. So on a $500,000 mortgage, it's going to be a $20,000 mortgage default insurance premium. The good news for you, this insurance premium does actually go down the more you put down for your down payment, and it goes in increments of 5% down. That insurance premium is going to be 4%. With 10% down, it's going to be 3.2%. And with 15% down, it's going to be 2.8%. So it does get cheaper the closer you are to 20% down. And then, of course, once you're at 20% down, it is no longer required and you're allowed to get an uninsured mortgage. It's important to understand that 20% down is actually the riskiest loan for a lender, because it's the lowest amount down that doesn't require the insurance. Therefore, when you do put 20% down, the bank typically requires what's called an appraisal to verify the value of the property. And this can typically cost you between $400 and $500, but at the end of the day, that's still a whole lot better than the $10,000 plus you're gonna be paying for that mortgage insurance if you had to get it. Now, if you're thinking an insured mortgage might be better simply because you're not paying that appraisal fee and you're getting a better interest rate, think again, because the difference in interest rate and that appraisal fee comes nowhere close to that cost of the insurance premium. However, once you start to put more than 20% down, it becomes a little less risky for the lender. And once you actually reach 35% down, you have options that are pretty much the same rates as the insured rate. And on top of that, you can oftentimes even get this appraisal that they're requesting waived due to the fact that it's quite a bit less risky for them because they're only lending 65% of the value of the home and they're not going all the way up to that 80% mark. When you're picking a mortgage, you can either choose a fixed rate mortgage or a variable rate mortgage. And a fixed rate mortgage is exactly how it sounds. You're picking a fixed rate for an extended period of time, whether that be 1 year, 2 years, 3 years, 4 years, or 5 years, and that is the rate that is set in stone for that period of time. So your payment's not going to change, your rate's not going to change, everything's going to stay the same. Now, what's nice about this is the fixed rate mortgages offer stability, but one thing you need to consider is the payment to get out of them early is quite substantial. Now, a variable rate mortgage is a bit more confusing. It's like the fixed rate mortgage in the sense that you have a term, typically 5 years with variables is all the banks will offer. Now, you have a discount of the Bank of Canada prime rate on your contract. This discount is really what you're negotiating and locking in for your term length. So for instance, say the Bank of Canada prime rate is at 6%, you might have a 1% discount on your contract. That means throughout the entire term, no matter where the Bank of Canada prime rate goes, whether it's down or it goes up, you will always be 1% lower than that. Now, a variable rate mortgage is a bit more complicated because there's a couple things to know. And one thing is that you're allowed to lock in that variable rate mortgage at any point in time throughout your entire term. So basically, if fixed rate started to go down and you had your variable rate that was still up pretty high, you could actually lock in your variable down to what those fixed rates are being offered at. However, you do have to lock in for the remaining years you have left or more. So as an example, if you had 3 years remaining, you couldn't lock into a 2 or 1 year term. It would have to be a 3, 4, or 5 year term you lock into. Now, the reason why variable rate mortgages were so popular for so long, especially before 2022 and 2023 when rates shot up, is because they have a very low penalty to get out of them early. And they're quite common amongst most first-time homebuyers for that very reason, because life circumstances are changing all the time. You might start with a 1-bed condo, then you need more room, so you go to a 2-bed condo, and then maybe you start a family, you go to a townhouse, and that can all happen in a very short period of time. And therefore, if you're taking a fixed rate and you're constantly breaking it early, you're pretty much eating away at all that equity you built up because that penalty is quite substantial on the fixed rate mortgage. However, with a variable rate mortgage, you're only ever paying 3 months interest, which is one of the major benefits to them. And historically, over time, variable rate has always beat out fixed rates, except for the last couple of years in 2022 and 2023. That is literally the only time in history where variable rates have lost to fixed rates in the sense of total cost. So after witnessing what happened with variable rates rising, I wouldn't say it's a good idea to completely write off variables, but you're gonna wanna be a bit more cautious just relying on historic data, because that's what a lot of people did in 2021, and now they're sitting with a rate that is 5% higher than what they could have got if they went into a fixed rate. Okay, now I hope you're following along, because this is where it's gonna get a bit more confusing, and I apologize. So when it comes to a variable rate mortgage, there's actually 2 different types of variable rate mortgages. You got your static variable rate and you got your adjustable variable rate. Some banks only offer adjustable ones. As an example, Scotiabank is an adjustable, TD is a static. So a static variable rate mortgage basically means that if interest rates were to increase, your payment actually stays exactly the same. Same thing for if interest rates go down, your payment stays exactly the same. Now within your mortgage payment, there's 2 components. There's a principal portion and there's a portion that goes towards interest. So a portion goes towards your loan, a portion goes towards interest. Now when rates rise and you have a static variable rate mortgage, now it's just the makeup of that payment is changing. So more of it will go towards interest and less of it will go towards your loan. And this results in you paying your loan off a little bit slower, but you have the stability of having the same payment. Same thing vice versa for if rates went down, you are gonna pay your loan off a little bit faster because less of that payment is going towards interest. So with an adjustable variable rate mortgage, if interest rates were to go up, your payment actually increases to match that. And what that's doing is it's making sure that you stay on track with your amortization. Now, if rates go down, your payment also goes down. So you're never going off track of that amortization, but your payment fluctuates a bit more. Now, it's important not to mistake term and amortization as the same thing. So your term length is that contract that you signed on for the 1, 2, 3, 4, or 5 years. And your amortization is the total life of your mortgage, how long it's gonna take to pay off that entire loan. Now, you might have started with a 25 or 30-year amortization, and you have a 5-year term. So then after the 5 years, you would then have 20 or 25 years left, depending on what you originally chose. Now, once you actually have a mortgage and you're making those mortgage payments, you can actually choose the frequency that you make them. So you can make your payments monthly, bi-weekly, semi-monthly, weekly, and there's 2 other options called accelerated bi-weekly and accelerated weekly. Now, the difference between accelerated payments and non-accelerated payments is with the accelerated payments, you're gonna pay your mortgage off quite a bit faster and save quite a bit of money on interest. So for instance, with bi-weekly payments, they're essentially taking your year's worth of payments and dividing it by 26. Whereas with accelerated payments, they're taking your monthly payment, chopping it in half, and you're making that payment 26 times. And essentially what this means is you're making 2 extra payments every single year, which all go towards just your loan amount, which reduces your loan amount, which then saves you a lot of money in interest. I always recommend accelerated bi-weekly payments if you can actually manage with that payment, because you will be paying a little bit more and there will be 2 months of the year where you have 3 mortgage payments come out. But if that is something you can handle, great. When you're thinking about getting a mortgage, there's 2 different ways you can go about doing it. You can get an underwritten pre-approval or a non-underwritten pre-approval. And basically what the difference is with an underwritten pre-approval, you're having someone take in all the info, all the documentation, and doing a very thorough review to make sure you're getting an accurate number on what you should shop within. This is what I always recommend, and this is the only thing that we do at White Ridge Mortgage. We don't bother doing the non-underwritten pre-approvals because at the end of the day, that number that you receive through an online mortgage calculator or even through the bank, if you aren't supplying your documentation, it's highly likely that it's not accurate. And that leads me to exactly what a non-underwritten pre-approval is. It's essentially you're just giving a bit of basic info, no documents are being reviewed, and a number is getting spit out on how much you can borrow. And it's so important that you do not rely on these numbers because I've seen so many horror stories from past clients that maybe shopped at the bank or went to an online calculator, got a number, put an offer on a place, and sure enough, they got declined. It is always best to talk with a mortgage broker and have a proper pre-approval done. I say mortgage broker because honestly, the debate is over. It is 1000% better to get your mortgage done through a mortgage broker than the bank. And this is simply because as a mortgage broker, we have access to way more lenders, way more products, and we typically just have a better overall understanding of the market and all the products that are available. It is actually a fact that the majority of people that get a mortgage through a mortgage broker don't end up getting a mortgage from the bank they bank with. And this is typically because there are so many options out there, and there's honestly very likely a better option than what your current bank can offer. And on top of that, at the end of the day, a mortgage is simply just a mortgage payment coming out of your account. You do not need it all under one app where you can see it. You're just paying it off very slowly. There's not really much you can do with the mortgage once you already have it, other than changing your payment frequency, which is something you can do with a simple phone call. Now, the last thing I wanted to address quickly is what the bank actually assesses when you're going to get a mortgage. They're going to review your income, your down payment, your credit, your debts, and one thing that people don't often consider is they're actually going to review the property as well. The property is an extremely important piece of the puzzle because essentially the property is what they're actually lending their money against. They want to make sure that in the event that they need to take it back, the property is actually marketable and they can sell it to recover their money. So they need a great borrower and a great property. Therefore, please make sure you are using a mortgage broker, whether that's myself or any other broker when you're buying a home. There is simply just way too much that goes into this transaction and you need to have the proper guidance. Now, if you are looking to get pre-approved, I did put a link in the description where you can apply directly online to work with us over at White Ridge Mortgage. However, if you are just looking for rough ideas, I also included another link for my online mortgage app where you can do one of those pre-qualification quizzes that spits out the number. Once again, do not rely on this number, but it still is a great tool to get a rough idea. So now that you know all the basics about getting a mortgage in Canada, I hope you managed to gather some value from this video. And if you wouldn't mind, please hit that like button, subscribe to the channel, and ring the bell to be notified when more videos just like this come out. It would mean a lot. It really helps this channel grow. Just want to say thanks for watching, guys. Catch you on the next one.